Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 25th, 2023. I'm going to begin, as I do each time, with a piece that was kind of the highlight from last week. And my client, Greg, thank you, Greg, sent me this piece from the Wall Street Journal, and I want to replay it. I played it yesterday in my broadcast yesterday. And it's an article that talked about the significance of the decline in bonds. Now, bonds, there are people who buy just bonds. There are people who buy just equities. But most people, particularly as they get older, buy stocks and bonds. That has been true for 40 years. Bonds have provided a counterbalance to stocks or equities and softening the downside risk until bond prices hit a bottom. And that bottom for the, let's just say the 10-year or the 20-year bond was around 2%. And that became the floor. And that was the same time when interest rates were at zero. So where did bonds have to go? Bond yields have to go from there. Nowhere but up. And as bond yields go up, bond prices, bond fund prices, and bond ETF prices have nowhere to go but down. So this chart shows dramatically the level of increase that from 1945 to present, and particularly if you look at the segment where it starts to go up, and it goes up pretty straight from about early 1980s till 2021, or even 2020. So about a 40-year period of time, bonds went up. Investors and traditional financial advisors got lulled to sleep thinking bonds are a good counterbalance to stocks. And the business schools teach this, by the way. This is conventional thinking. I don't know what percentage of people that use portfolios like this or financial advisors. It's a very high percentage, I suspect. So, but they got lulled to sleep while interest rates were coming down and hit zero, and nobody was saying, wait a minute, interest rates are going to go up from here at some point. We know, everybody knows, that bond prices go the opposite direction from yields. So as yields start to go up, bond prices start to come down. So that's what this chart shows. It shows the magnitude of the drop in bond prices. And it goes back, I think you can now go back to 10 or 15 years now. I think I saw a number that said that bond prices were at the level that they were in 2007. Wow, that's 16 years. So that is a big drop. Now that comprises the 40% or 50 or 30 or whatever, usually about 40% of the portfolios. Last year and this year, both years, bond prices have been coming down. I don't know where the bottom is. At some point, they've got to go up, at least in the short run, go back up a little bit before they continue decline. I don't know. I don't know the future of bond. But I do know that if interest rates start to come down, or the perception is that they're going to start to come down, that my opinion is that bond prices will start to go back up. But it has been for quite a while, 3 years now, it's been a bloodbath in bonds. And if you can isolate and look at the bond portion of your portfolio, you'll know what I'm talking about. Okay, to the dashboard. This week was a bad week. It was a bad week in equities and in bonds. So this shows the 6 equity indexes going from top to bottom, and the long-term government bonds at the bottom. So in the yellow box, I put last week, and the pink box, I put this year to date. The pink box is the way I sorted it. So going from top to bottom, so you've got 2 indexes, the NASDAQ 100 and the S&P 500, that have any kind of gain at all. The S&P has a gain of 10%, and the NASDAQ 100 a gain of 33%. That's mostly tech stocks. And most of that gain has come out of 7 stocks. 7 stocks, the magnificent 7 technology stocks. And then the developed markets and the Dow, slight gain, maybe break even, and then definite losses in emerging markets and small companies. And then a huge loss in bonds. Now, bond prices last year, the long-term government bond price last year, I'm sorry I can't quote it exactly, but it was down somewhere in the 20s, 20% plus. Might have been 25. But I know at one point it was down more than that. But I think at least 20, maybe 25%. This year, on top of that, it's down another 16%. So just crushing portfolios. So most portfolios are negative right now. If you look at the and the equity side of portfolios, I've never seen one that equaled the S&P 500. They're usually worse than the S&P 500. So if you look at the S&P here, it's a positive 10%. The long-term government bond, not everyone's in long-term government bonds, but just using that one, is down 16%. And so it just tells me that most portfolios, a good portfolio is probably breaking even for the year. And then most of them probably are negative. For the week, you can see a lot of them were down, 1 to 2%. And then, of course, the government bond was down almost 5%, adding to the previous loss of about 11, bringing that loss for the long-term government bond down to 16%. The far right side are the dots that show the moving averages, the 20, the 50, the 100, and 200-day moving averages going from left to right, and where each of them stands in relation to those moving averages. So only 2, the NASDAQ 100 and the S&P 500, are above their 200-day moving average. They are below, even those are below their 20, 50, and 100-day moving averages. This is very bearish and negative data. At some point they will turn around. I don't know what that's going to take. Probably some kind of news related to the Middle East or interest rates or inflation would be my guess, but I don't know. But for now, it's negative. When we look at the S&P 500, break it apart into its 11 sectors, the component parts of the S&P, you can see, again, the same thing in the yellow box this last week and the pink box year to date. The pink box tells you that the technology stocks, XLK, was up 32% for the year, and the consumer discretionary is up 17%. A slight gain in energy, and energy has been doing well lately, and slight gain, maybe break even for the industrials. Other than that, the remaining 7 indexes, or 7 sectors, are negative for the year, going from a negative 1% all the way down to the real estate, which is a negative 10% for the year. For the last week, they were mixed. Energy had a good week, retail had a good week, and consumer staples finally had a good week. All the others were negative. Consumer discretionary down 4%. When I put these on the chart, it's a weekly chart showing 1 move equals 1 week, and with a 20-period moving average running through the data, this is an 18-month chart of the S&P 500 represented by the ETF SPY. And for the last few months, it'll say the last 3 months, I put a black arrow at the end of it showing that the S&P 500, the degree to which it has been declining. So you can see that. It's had some slight moves up, but mostly it's been in a period of decline and seems to be accelerating at this point. When is it going to turn around? I don't know, but it certainly has been a negative week. This is a relative strength chart showing growth stocks divided by value stocks. SPY-G in the S&P 500, the growth stocks, divided by the value stocks. And the black arrow shows from the beginning of this year until today, you can see this goes up and down, but primarily it's been going in an upward direction favoring growth stocks. This last week was value stocks were more in favor, but generally growth stocks have been outperforming value during this 10-month period of time. This is an interesting chart showing the large companies, S&P 500, SPY, divided by the Russell 2000 small cap index, IWM, and you can see the degree to which large companies have outperformed small companies. Said another way, do you see the degree to which small companies have underperformed the market? And we saw that in the previous data when we saw the first dashboard showing the small companies really struggling currently this week as well as year to date. And here's the culprit again, the long-term government bond, exchange-traded fund, TLT. This is a 24-month chart showing the weekly moves in the long-term government bond for that 24-month period of time. You can, and there are periods where it goes up a little bit, but look at the degree to which that continues to decline. What that tells you is that, number one, interest rates are going up, which will cause this to go down. The second thing it tells you is that the perception of people is that interest rates are going to continue to go up for the foreseeable future, because the market, this being an indication of the bond market, reflects, it anticipates what's going to be happening in the future. So this is telling you that they anticipate rates are going to continue to go up. Another 24-month chart, you can see this is the dollar relative to other currencies. Doesn't mean the dollar's wonderful. It may mean it's less worse. I guess that's a phrase, a less worse, than the others. But anyway, it's been increasing in value for the last few months relative to other currencies. Gold had a very good week, another good week. So what that move up at the far right of the chart shows, that goes kind of straight up, that's 2 weeks, 2 weeks of data. Last week, gold went up 5.5%. This week, it's up 2.5%. It's up about 8% for the last 2 weeks. Silver, very similar, up about 5% last week, up a couple of percent this week, and both definitely rallied from where they were 2 weeks ago. Relative to each other, pretty much a flat week, so it didn't really go up or down much. This just shows that if it goes up, that favors silver is doing better, and if it goes down, then gold is doing better. Bitcoin had a very good week. You see the little tick up at the end, that's this week, and crossed over its 20-period moving average. And we have a Bitcoin strategy or a crypto strategy, and we entered the market, and so we'll see where that goes. We're looking forward to that being positive, but so far so good. Volatility index, the volatility, because the market was down so much and there was just no good news out there, so that pushed the volatility index up to 21, and it wasn't very long ago when it was at the bottom and it was 13. So from 13 to 21, that's a big move. And I put the black mark at 24. So that's my indication when it moves over that, when it comes from the bottom, excuse me, and goes above 24, particularly if it's a rapid move, usually that means it's moving higher. That's a sign that quite a bit of volatility has entered the market. Now, it's gone up a lot, so it wouldn't surprise me to see some kind of a pullback, before it makes another move up, if that's the way it actually ends up going. Gold and silver, as of last Friday, gold price, spot price is $1,983 per ounce for generic gold. And that is getting close to 2,000. I don't know if it gets above 2,000 where it's going to go, but a lot of people talk about once it gets above that it tends to push up from there. The gain this week was 2.4%. Silver is 23.42. The gain this week was 2.8%. Now I'm speaking of the spot price. So that's for, that does not include the markup. The ratio, gold over silver, is 85-1. That's constant from where it was last week. That favors silver as a better buy, because that's anything, in my opinion, anything above 40 makes silver a better buy over the long haul. The monster box is a box of 500 rounds of silver, generic rounds, and 1 ounce rounds, so 500 ounces. And so a silver or a monster box costs $12,830, still under where it was several months ago when it was 14,000, 4 or 5 months ago. So, but it's definitely been, as you saw in the numbers, definitely been moving up. This includes, so you take the spot price, which was $23.42, and add $2.24 to it, and you get $25.66 per round when purchased in quantities of 500. And it's another 50 cents per round on top of that if you buy it in a tube of 20. And my son, Preston, is the source of my information. So the guy proposing to his girlfriend, I guess, and presenting the shiny ring, she responds, "I'd love to, but I'm already in a long-term relationship." Now, she's not holding hands with the student loan officer. She's handcuffed to him. I think you get the picture. Thank you for watching. Feel free to leave comments in the comments section below. I do appreciate your comments. You've left many good ones, and I appreciate that. And so feel free to reach out to me if you have questions, and I'll be glad to answer those as well. Thank you.